Welcome to today's class. So on today's class, we will decode the metal sector. Many of you get super excited about the fact that these metal stocks have very low price to equity ratio, have very low price to book ratio. So should you go and invest your hard-earned money in this sector? That is the precise conversation that we are going to have. There are three specific topics that we are going to discuss. First, I will help you understand the industry overview of the metal sector. Second, I will help you decode some of the key points associated with the metals industry. And third and finally, we will go through an investment checklist that you can use to make better decisions in this sector. So let's get this class started. So the industry can be understood through three simple points. First and foremost, it is the nature of the company itself. For example, we have many metal stocks where the government intervention is very, very high and government is the majority shareholder. An example could be NALCO or NMDC. We also have large private players like Tata or Jindal Steel, which is into this metal space. The second key point about the metal space is the nature of the product. For example, many companies deal with primarily the raw material parts of the equation. For example, they will manufacture steel. So that is a raw material that acts as a fodder for the industry growth. And on the flip side, we have companies like Titan that are rolling out the finished product. Third and finally, we can understand this industry from a market dominance point of view. For example, some companies like NALCO have 25% market share in the aluminium segment in India. So this is a fairly big market share and gives them a dominant market position in the Indian economy. Next, let us try to understand what are the key associated points that can help you make better investment decisions. So there are four specific points that you need to understand about this industry. First and foremost, this industry is extremely cyclical. When I say cyclical, I'm not talking about in terms of year or 1 year or 2 year. I'm talking about decade-based cyclicalness in this industry. For example, there are stocks that do not move for a decade. I will explain this point further on this class. The second key point that you need to understand is that almost every single company in the metal sector is capital intensive. It requires a lot of capital expenditure, capex. Therefore, they end up taking a lot of debt. So the third point that you need to understand about this industry is that predicting demand is extremely complicated and difficult. For example, you can't really predict the demand of gold, whether the supply or demand of gold is going to rise tomorrow. Same applies to steel, same applies to nickel or copper. Therefore, predicting the stock price movement is really difficult as well. I will talk more about it when we discuss this topic through an example in the class subsequently. Fourth and final point is that this entire metal stock industry is dependent on other sectors. What will be the demand of auto and bunch of other different industries and the economy at large. So let us start discussing some of these key points in slightly more detail now, starting with the cyclical nature of the business. To understand this cyclicity, take a look at two charts now. Chart number 1 is here, and you can see that the gold prices did not move for roughly 1.5 decades between 1985 to 2000. Now take a look at steel chart. This will show you that the steel prices did not move much between 2010 to 2020. What does this show you? It categorically shows you that these commodity cycles are fairly long and fairly cyclical. Why does this happen? Because the commodity prices go up when industry expansion or economic expansion take place. When the economies are expanding, the industrial demand also expands. So as a result, there is more demand of commodities. The opposite happens when the industry demand shrinks or the economies are shrinking. During such phases, what ends up happening is that due to poor industry demand, the commodity stocks or metal stocks suffer a lot. A related point here would be the supply shock that happens sometimes. For example, if a war breaks out or if there is debt crisis or real estate crisis in any part of the world, then again the commodity stocks suffer or metal stocks suffer simply because of the fact that the entire economies are suffering. This was exhibited very recently in China when the real estate and the debt crisis broke out. As a result, the global commodity stocks and the metal stocks also fell. These talks about the external exigencies, but if you have to understand the internal dynamics of these metal stocks, we must start looking at the high capital nature of these companies and why they take on so much debt. So a lot of investors get super happy when they study the price to equity ratio or price to book ratio of these metal stocks, because majority of these metal stocks trade at low PE or low price to book ratio. So as a result, they think that, hey, if I am buying that metal stock at a low PE, it will definitely go high. But can you really predict the prices of a metal stock? Let us start understanding that through a simple example. So let us take a simple example of JSW Steel and Maruti. Now JSW Steel is a steel producer. It will produce steel and give it to Maruti. Maruti will pick up that steel and manufacture that into a car. Of course, there are a range of other products that are there in the middle, but for simplicity, let us simplify this example. So here we have JSW Steel. It is producing steel at 1000 rupees per kg. And on the flip side, we have a buyer of steel, which is Maruti. And let's assume that it is buying this steel at 1000 rupees per kg from JSW Steel. So in this example, JSW Steel is the supplier and Maruti is the buyer of steel. Now think about it, that what would JSW Steel be scared of? It would be scared of the fact that what if the price, which is at 1000 rupees per kg, if the price of steel goes down to, let's say, 800 rupees, they will start thinking that, hey, I will end up making a lot of losses because I'm supplying tons and tons of steel. On the flip side, what would Maruti be scared of? It would be scared of the fact that what if the steel prices go to 1200 rupees per kg? Then they will be sitting on a loss because they are procuring so much steel. So on one hand, we have Maruti, which is scared of the price increase. And on the flip side, we have JSW Steel, which is scared of a price drop. And their entire business is dependent on what? It is dependent on this price prediction of steel. So what they end up doing is that they do something called as futures or forward contract. Now, here we have billion-dollar companies whose entire job is to predict the steel prices, and they are not able to predict it. Therefore, they explore routes like future forward contract. And here we are as retail investors who are trying to discover what the price of steel or gold tomorrow will be. It is close to impossible to predict the prices of steel or different commodities because there are several macroeconomic factors at play. So what are these macro factors? Let's start discussing that now. Now, if you analyze the macro factors, it is almost impossible to predict global demand, global supply, and local demand, local supply. Think about it for a minute. Pick the example of gold. You can neither predict how much gold will be extracted in the world next year because this in turn depends on government regulations, government policies. Similarly, the demand of gold depends on people's discretionary income and other asset classes. So from that viewpoint, you cannot really predict the price of a particular commodity. So take a look at this article, for example. It talks about the actions of steelmakers. They ended up purchasing distressed assets. What are distressed assets? These are assets that have been purchased at a lower price. Now, despite getting massive discounts on these distressed assets, these steel makers suffered due to the downturn in the construction and auto market. What does the story depict? It simply depicts the fact that the commodity prices, including steel and other metal, is highly unpredictable, and even big steel makers are not able to predict these things accurately. So therefore, we must be really careful of not getting caught up with metal stocks on a wrong end of a cycle. So in case you want to become an investor in metal stock, here is a quick investment checklist for you. First and foremost, figure out what part of the value chain you are investing. For example, there are typically two types of metal stocks. One is pure commodity / metal stocks. These would be companies manufacturing steel or processing iron ore. So they are dealing with the commodity itself. These type of businesses will have very low profit margins and would typically exist at a very low PE ratio. The second type of businesses convert this raw material into something more useful. Titan would be a classic case that it picks up gold and converts that into watches. So as an investor, you should typically take positions in these second type of companies because the profit margins are usually higher. The second key point that you need to remember here is that you must understand the moat or the winning advantage of a particular business. Consider, for example, in many of these metal stocks, government is the primary shareholder. So these type of businesses are not necessarily run for churning out profits. They are run to provide critical inputs to the industry and growth of the nation. So ideally, as investors, unless you are getting these type of stocks at a massively discounted price, you must be very careful before taking positions. On the flip side, there are private businesses where a lot of action is coming in. A classic case in point would be Tata Steel. So Tata Steel is a part of the Tata Group. Tata Group has recently entered into the EV segment. Now, if electric vehicles are getting produced, there is a very high likelihood that they would procure this raw material or steel from Tata Steel. So consider these basic points before making an investment. Third and final point is around the key ratios that you must analyze before entering a metal stock. So the first key ratio that you should look at is the debt to equity ratio. Here, if the debt on a particular metal stock is very high, you should be a little bit concerned. Yes, it is right that almost all these metal stocks will have high debt, but there is a level up to which you should go. You should not play with companies that are in critical debt. Second key ratio that you need to remember is the inventory turnover. It simply means that how fast a particular company is moving its inventory or selling its inventory. The third key ratio is the creditor turnover ratio. It simply shows that if a company is selling its product, then how soon the buyers are paying that company. The fourth and the final ratio is called as enterprise value to EBITDA ratio. It simply has the debt component on it. So it shows the true value of a particular company and allows you to consider the debt level and the capital efficiency of a particular enterprise. If you keep some of these key ratios in mind, it will refine your investment style. I hope you enjoyed the class and learnt a lot. I will see you the next time.